Chapter 2, we learned the first 3 steps in the accounting cycle. And then in Chapter 3, we picked up where Chapter 2 left off, and we continued on with the accounting cycle. Chapter 4 picks up where Chapter 3 left off, and now we're going to complete the accounting cycle. So let's review what the accounting cycle is. All right, step 1, analyze source documents, right? Meaning invoices, purchase orders, sales documents, right? And we record the transaction in the journal, right? We're making the journal entries. Step 2, after we've recorded the journal entries, then we post to the ledger, and that's where we get our balances. After we have posted to the ledger, we prepare the unadjusted trial balance. So steps 1, 2, and 3 were covered in Chapter 2. Step 4, we prepare the adjusting entries and the adjusted trial balance. So this was covered in Chapter 3. We didn't get into the optional worksheet. That was done more prevalently when people were doing this all by hand. Now that it's computerized, the worksheet isn't necessary. And so we're picking up after step 4, right? This is Chapter 3. And in this chapter, we're going to look at preparing the financial statements, preparing the closing entries, and then the last step in the accounting cycle is we prepare the last trial balance. It's the post-closing trial balance, the after-closing trial balance. And so we learn the financial statements. So this is what I'm going to talk about first, is the financial statements. We learned them back in Chapter 1, and we learned you had to do them in order. The income statement was done first because we needed the net income for the retained earnings statement, and you needed the ending retained earnings to do the balance sheet. And so what we're going to look at in this chapter is a more detailed balance sheet called the classified balance sheet. And so it's called the classified balance sheet because the assets and the liabilities are going to be broken into classifications. So for assets, we're going to first show our current assets. So these are the assets that are going to be used up within 1 year or less. So our cash, we're going to use that within 1 year. A note receivable, if we have loaned someone money, they're going to pay us back within a year. That would be a current asset. Accounts receivable are typically, short-term, 30 days, 60 days tops. Supplies are going to be used up within a year. Prepaid expenses are going to be used up within a year. So we're going to show all of those first, your current assets, and then list them all, come to your total current assets. And then we show our long-term assets. So anything that we're going to have for more than a year. So if a long-term investment, an investment that we're going to hold for more than a year. Our plant assets or our fixed assets that we talked about last chapter when we talked about depreciation, land, building, furniture, equipment. Intangible assets are also going to be long-term. And we'll talk about intangible assets in a later chapter. So here's how our plant assets will look. So land does not get depreciated. We'll talk about that again in the depreciation chapter. So the cost of the land is the book value of the land. Here we can see the building and the accumulated depreciation. And we know the accumulated depreciation gets subtracted from the cost of the building and the book value. So all of your categories of plant assets other than land will have their building and their accumulated depreciation. You subtract to get the book value. And then you add together all of the book values to get the total property, plant, and equipment. And then you'll add together the current assets, the long-term assets, the plant assets, the intangible assets. Not all companies have intangible assets or long-term investments. And you'll get your total assets. Then you move on to your liabilities. And your liabilities are going to also be broken down into your current liabilities, those that are going to be due within 1 year. So a note payable that's due within a year, your accounts payable, your unearned revenue, wages payable, interest payable. Those will all be shown as your current liabilities. Your long-term liabilities, such as your mortgage payable, anything that's due after 1 year. Now, interestingly, your mortgage payable right? You got a mortgage, it's going to be a 15-year mortgage or a 20 or a 30-year mortgage. And so most of your mortgage is going to be long-term. However, you make your mortgage in monthly payments. So the portion of your mortgage that you're going to pay within a year is going to be shown up here as a current liability. You'll say your current portion of your mortgage payable will be shown up here. And then the rest of your mortgage, everything that's due after 1 year, is going to be shown down here as a long-term liability. And then for our purposes, after we get our total liabilities by adding the current liabilities and long-term liabilities, then we show our stockholders' equity. And we know we have to show that our accounting equation balances, so we add together the total liabilities and stockholders' equity, and that amount needs to equal your total assets. So let's take a look at Apple's classified balance sheet. We can see here's the assets, the current assets, cash, marketable securities is short-term investments. These investments are intended to be held for less than a year. Accounts receivable, inventories, non-trade receivables, and then other current assets such as your prepaid expenses, supplies, etc. And then here's our non-current or long-term assets. So here's marketable securities. These are investments that we're holding long-term. Property, plant, and equipment net. So here we would go to the notes of the financial statements, and they would show the cost of the property, plant, and equipment and the accumulated depreciation. So here I have gone to the notes of the financial statement, and here they talk about how they're treating their depreciation, how they're calculating the depreciation, and then they tell you the depreciation amortization expense that they've calculated during the last 3 years. So they're not showing how they got the book value on the face of their financial statements. They explain the detail in the notes to the financial statements. Okay, so they added together then their current assets and their long-term assets, and that's how they got their total assets. And then under liabilities, we show our current liabilities. These are the ones that are due within a year, accounts payable, other current liabilities, so that's probably their wages payable, their interest payable. Deferred revenue, that's their unearned revenue, okay? Other things that we haven't talked about yet. We get to our total current liabilities. Then our non-current liabilities or long-term liabilities. Here's the liabilities that are going to be due after 1 year. We get our total non-current or long-term liabilities. We add together the current liabilities, the long-term liabilities. Here's our total liabilities. And then here they show their stockholders' equity. And then they add together the total liabilities, $248,028, the total stockholders' equity, $90,488, to get our total liabilities and stockholders' equity, $338,516, and that is the amount of our total assets. So that's how the balance sheet, the classified balance sheet, is prepared. And going forward, we will be talking about current assets and current liabilities.